Good day, and thank you for joining me. My name is Gana, and today I will be delivering a detailed investment pitch for PT GOTO, Gojek Tokopedia Terbuka, or TBK, which is the most prominent tech ecosystem in Indonesia currently. In this session, I will walk you through GOTO's background, strategic motives behind its initial public offering, risk and performance evaluation, as well as a comprehensive stock valuation. This analysis draws on my 5-year financial model and is deeply rooted in the theories and frameworks outlined in the book, Investments, Analysis and Management by Charles P. Jones, 12th edition. Our goal is to determine whether GOTO is currently undervalued and whether it offers a compelling opportunity for long-term investors. Right. So moving on, I will talk about the company overview. PT GOTO, Gojek Tokopedia Terbuka, is the product of a major consolidation in Indonesia's digital space, which is a merger between Gojek and Tokopedia in 2021. The group now operates across three synergistic business verticals. Number one is Gojek, providing ride-hailing and on-demand delivery services. Second is Tokopedia, facilitating e-commerce across millions of merchants and consumers. And third is GOTO Financial, which offers digital payments, lending, and financial services. The company serves over 500 cities and supports over 2.6 million drivers and 15 million merchants. This vertical integration strategy reflects Chapter 1's concept of portfolio synergy, which states creating economic value by combining services that share customer bases, infrastructure, and data platforms. From the balance sheet, we observe a platform with a large asset base and capital structure to support scale and expansion, essential for business in its growth phase. All right, so moving on, I will talk about the objective of their IPO and the company actions. Sorry. Okay. So in 2022, GOTO launched its IPO, raising approximately 13.7 trillion Indonesian rupiah. This offering was more than just a funding mechanism. It was a pivotal move towards long-term public capital accesses, business integration, and shareholder liquidity. The objectives of the IPO were threefold, which is one, to reduce dependence on private equity funding and gain access to wider capital markets. Two, to finance ecosystem expansions, especially in financial services and logistics infrastructure. And three, to offer exit and liquidity options for early-stage investors and employees. Preceding the listing, GOTO restructured its equity distribution, issuing restricted stock units and fully diluting shares to over 1 billion units as reflected in the diluted shares outstanding tab. There were no major de-investments. Instead, the company focused on strategic consolidation. According to the chapter 3 of our textbook, this is consistent with an indirect investment strategy where reconstructing ownership and broadening investor participation creates long-term value. All right. We will go to risk analysis. So risk is a fundamental aspect of investment decision making. And in chapter 6 to chapter 9, it emphasizes two dimensions, which include systematic and unsystematic risk. First, systematic risk. Systematic risk or market-wide exposure arises from inflation, interest rate shifts, and currency fluctuations. GOTO, operating in an emerging market with a high beta, is more sensitive to these macroeconomic forces. The tax and WACC tab, the one I'm showing you right now, shows GOTO's cost of equity was derived using the CAPM model, or CAPM, where a higher beta increases the required rate of return and ultimately impacts the valuation discount rate. This aligns with the theory in chapter 8, which states greater market risk demands high return expectations. And secondly, I will talk about the unsystematic risk. Unsystematic risk relates to internal factors, including GOTO's history of operating losses, competition from regional platforms like Grab and Shopee, and the evolving regulatory environment in digital finance. However, Chapter 7 notes that these firm-specific risks can be mitigated. GOTO is addressing them through revenue diversification, improved operational control, and aggressive cash flow management. These risk dimensions directly affect how investors perceive valuation volatility and risk-adjusted return. All right, so moving on, I will talk about the business environment itself and the performance. Give me a moment. Okay, so in chapter 13 to chapter 15, it guides us in analyzing economic backdrop, the economic backdrop sector, the economic backdrop, sector dynamics, and firm level performance, all of which are crucial for investment evaluation. So the business environment, Indonesia is a mobile-first, high-growth digital economy with rising urbanization and an expanding middle class. GOTO operates at the intersection of three growth megatrends: digital commerce, on-demand transport, and financial inclusion. These conditions support a structurally favorable macroeconomic environment for GOTO's long-term expansion. For the company performance itself, using the revenue and expenses forecast, we project that the revenue growth from approximately 15.8 or 15.9 trillion Indonesian rupiah in 2024 to over 36.7 or 36.8 trillion by 2030, which shows a compound annual growth rate exceeding around 15, let's say 15 to like 14%. Operating and our projections, other projections are that operating costs scale gradually, which reflects controlled expansion, and for the positive EBITDA. The positive EBITDA, we expect that that GOTO will have a positive EBITDA by the fiscal year in 2028, indicating it will be approaching profitability. These are the signals of a growth stage company preparing for break-even and align with the textbook discussions on earning momentums and valuation inflection points. All right, so I will be talking about the valuation snapshot. So we can focus on the little box up here. So let us take a moment to summarize GOTO's market price compared to its estimated fair value. So for its current share price, it's worth around 83 Indonesian rupiah, and with its forecasted equity value of around 10.05 trillion Indonesian rupiah, and fully diluted shares outstanding is around 1,072 million shares, and its fair value per share using the exit multiple method around 9 Indonesian rupiah. The current price suggests undervaluation with intrinsic value approaching 9 Indonesian rupiah per share. This mismatch creates a potential margin of safety, which is central to valuation theory in Chapter 10, where market price often diverges from intrinsic value due to risk perceptions or behavioral biases. Right. So moving on, I will talk about the DCF. So in this slide, I will walk you through the valuation method using, first of all, the perpetuity method up here, also known as the growth Gordon model. This approach, detailed in Chapter 10, assumes a constant growth in cash flows beyond the forecast horizon, which assumptions I included a few assumptions, which includes the WACC is approximately 11.8%, and its terminal growth rate is around 4%, and forecasted cash flows are discounted from 2024 to 2030, and a terminal value is added using the perpetuity formula. While this value was not finalized in the Excel version, a previous estimate based on consistent assumptions yielded a fair value of 7 rupiah per share, showing a more conservative case relative to its exit multiple method. This demonstrates that GOTO valuation can vary based on terminal growth assumptions, making sensitivity analysis crucial, right, for the exit multiple method itself. Next, we apply the exit multiple method, where terminal value is estimated by applying a multiple to the final year's forecasted earnings, year's forecasted EBITDA, which the inputs I included is that the terminal year EBITDA is approximately 3.2 trillion Indonesian rupiah, and then the exit multiple is around 9 times of the EBITDA, which shows a conservative multiple based on industry comparables. And the adjustment that we made is that we accounted for cash and debt to arrive at the equity value. The result is a fair value of around 9 rupiah per share, as shown at the bottom of this discounted cash flow sheet. This valuation supports the investment case more strongly than the perpetuity method, and reflects market expectations from platform-type businesses in Asia. All right, so next I will be talking about the investment strategy, whether to buy, hold, or sell. All right, so in Chapter 11, it highlights 3 investing strategies. It highlights 3 investing strategies. I'm sorry, wait. Okay. 3 investing strategies. And in GOTO's case, I recommend a structured buy, hold, sell approach. Which number 1, buy. If you like to buy now with 83 rupiah per share, which trades below both conservative and aggressive fair value ranges. And if you like to hold through the next 2 or 3 fiscal years as the company approaches EBITDA, break even, and operating leverage improves. And if you like to sell at or above 130 rupiah, or if financial deterioration occurs due to unanticipated macroeconomic risks. This strategy offers investors a disciplined approach to entry, holding period, and exit balancing risk with long-term capital potential gain. All right, for the conclusion itself. In conclusion, based on a full spectrum analysis of strategy, financial risk, and evaluation, PT GOTO Gojek Tokopedia Terbuka is structurally embedded in one of Asia's fastest growing digital economies. Secondly, the company is moving steadily towards profitability with a realistic forecast based on data and disciplined cost planning. And third, both discounted cash flow methods, whether based on terminal growth or exit multiple, suggest intrinsic value above current market price. Therefore, GOTO offers a compelling opportunity for investors seeking exposure to long-term tech-driven growth in Southeast Asia. I guess that's it for my presentation. Thank you very much for your attention. I hope I can convince you to buy GOTO. Thank you very much.